What do you call it when a U.S. president slaps a 50% tariff on Europe, and Europe fires back by torching a $43 billion Boeing deal, rerouting trade through Canada, and triggering a $2 trillion shift in global commerce? Not a dispute, a controlled breakup. While Washington brags about leverage and rants over steel and peanut butter, Brussels is cutting new deals, courting China, and rewriting the rules without the U.S. in the room. This isn't a warning. This is the exit. And by the time America looks up, it may already be locked out. A $43 billion aircraft deal just vanished. EU trade with the U.S. is unraveling. Markets are reeling. But the real question now isn't whether the U.S. and Europe are in a trade war. It's whether the transatlantic alliance just collapsed under the weight of a 50% tariff. On May 30th, President Trump declared negotiations with the EU were going nowhere and called for an immediate 50% blanket tariff on all European imports starting June 1st, including steel, aluminum, cars, agri-food, and electronics. Within 48 hours, European stocks fell 2.1%. Boeing faced the real possibility of losing its largest export contract on record. According to Bloomberg, the potential loss to U.S. trade volume could exceed $2 trillion over the next decade if retaliatory EU measures materialize. Former EU negotiator Ignacio Garcia Bercero told Euronews, "If the U.S. won't reverse course, Europe has no choice but to escalate. But what comes after escalation? Europe may already have the answer, and it's not across the Atlantic." The European Commission didn't hesitate. In direct response to Trump's 50% tariff order, Brussels confirmed it was finalizing a second retaliation package targeting $95 billion in U.S. goods, while quietly moving to freeze a €43 billion Boeing aircraft deal. Reuters reports Ryanair's $30 billion order of 737 MAX jets is now under review, with CEO Michael O'Leary stating that Boeing's rising costs are no longer sustainable. Meanwhile, Airbus surged 3.4% on the Frankfurt Exchange. China's COMAC is suddenly in the conversation. An EU airline buying Chinese jets, once unthinkable, is now being modeled in Brussels trade forecasts. The U.S. aerospace sector, already down 6.2% year-to-date on investor concerns over supply chain bottlenecks, now faces structural contraction. But the real danger? This wasn't just a response to tariffs. It was a trial run for what life without Boeing and without America might look like. When the EU slapped counter tariffs on American staples like Harley-Davidson, Levi's, and peanut butter, it wasn't just optics. It was a direct hit on sectors tied to politically sensitive states. Harley's 2024 EU exports dropped 30% year-over-year. The company is now projecting $145 million in lost revenue through Q3 2025. But it was American agriculture that took the sharpest blow. U.S. farm exports to Europe plunged by $23.2 billion, according to the USDA. Wisconsin-based dairy co-op Land O'Lakes cited immediate operational strain following the EU's hike on butter and cheese tariffs. Meanwhile, the U.S. trade deficit hit a record $140.5 billion in early 2025, contradicting claims that tariffs would strengthen domestic output. As Bloomberg noted, tariffs meant to protect have instead exposed fragile dependencies. But the real pivot wasn't fiscal. It was geopolitical. The EU didn't just retaliate, it reoriented. While Washington burned diplomatic bridges, Ottawa built one. Under CETA, the EU and Canada eliminated 98% of tariffs, creating a frictionless corridor now projected by the European Commission to facilitate over €90 billion in trade annually by 2026. With U.S. tariffs driving up steel and auto prices by double digits, European firms like Siemens and Alolum have begun shifting procurement pipelines toward Quebec and Ontario. According to a May 2025 Financial Times report, Canadian-EU clean tech trade rose 41% year-over-year, led by a €1.2 billion hydrogen deal signed at last year's EU-Canada Clean Technology Summit. And while the U.S. shut itself out of climate-related funding, Canada offered open market access aligned with EU labor, digital, and environmental standards. Former Canadian Trade Minister Chrystia Freeland remarked in a recent Globe and Mail op-ed, "What began as a free trade deal has evolved into a strategic partnership. But the most telling sign of the shift? Europe is treating Canada not as a neighbor of the U.S., but as its replacement. This isn't just a tariff skirmish. It's the unraveling of the Western trade consensus. In just 10 weeks, a series of escalating duties, from 10% on aluminum to 50% across the board, have triggered retaliatory protocols, WTO complaints, and the potential voiding of at least two transatlantic megadeals. The EU has suspended a €21 billion retaliation package until July 15th. But the EU is preparing a second list targeting $95 billion in U.S. exports, pending the outcome of talks, according to CNBC. White House officials say they do not interpret Trump's posts as formal policy, yet European Commission spokesperson Olaf Gill publicly stated on June 2nd, "We are finalizing countermeasures that will take effect on July 14th or earlier." In other words, even if a deal is theoretically possible, time is mathematically running out. And behind the numbers sits the deeper rupture. Washington is escalating. Brussels is realigning. And the deadline is now less about tariffs and more about who the EU chooses to depend on next. While the US doubled down on tariffs, the EU quietly shifted gears, pouring investment into clean tech and trade infrastructure to reduce American reliance. According to the Financial Times, EU-Canada clean energy projects jumped 41% in 2024, with €1.2 billion earmarked for hydrogen and battery initiatives. The Clean Technology Summit, jointly hosted in Brussels and Vancouver, led to strategic agreements on solar component standardization, rare earth supply chains, AI-driven grid infrastructure. Meanwhile, under its REPowerEU initiative, the bloc committed to producing 20 million tons of renewable hydrogen annually by 2030, enough to offset nearly €60 billion in imported fossil fuels, according to Eurostat data. What's unfolding isn't just diversification, it's strategic insulation from U.S. policy whiplash. Now, with clean power flowing through new diplomatic circuits, it's becoming clear Europe's next industrial pivot isn't led by Washington or Beijing. It's self-funded, cross-Atlantic, and pointed due north. If Ryanair exits its $30 billion Boeing contract, it would mark the first time a major EU airline selects a Chinese Comac jet over U.S.-made aircraft, an outcome that once seemed inconceivable. But Bloomberg reports Ryanair executives are already in quiet talks with Comac, citing delivery delays, post-tariff price hikes of up to 14% on 737 MAX components. CEO Michael O'Leary warned that unless Boeing restores cost stability, all procurement options are on the table. A switch to Comac wouldn't just dent Boeing's balance sheet. It would legitimize China's entry into a Western-dominated industry, undermine FAA standard-setting influence, and fragment global aviation compliance. Airbus may benefit in the short term, but a Comac breakthrough in the EU's low-cost carrier segment would signal a power transition, one that reshapes long-term aircraft certification norms. The question isn't whether this would hurt Boeing. It's who gets to write the future of flight. CETA wasn't just a trade deal, it was a test run. And now Brussels is duplicating that model across Africa, Asia, and the Middle East. According to EU trade data, negotiators have opened 17 bilateral talks since 2023, many modeled on the CETA framework's zero-tariff, labor-aligned blueprint. The European Commission has quietly tied digital infrastructure funding to trade terms, offering joint investments in AI, semiconductors, and fiber-optic networks in Kenya, India, and the UAE. While Washington remained fixated on tariff retaliation, the EU, in 2024 alone, signed a €3.4 billion supply chain cooperation deal with India, fast-tracking non-dollar settlements in energy contracts. Wall Street Journal analysts note that Europe's trade strategy is shifting from defensive retaliation to structural repositioning, using CETA as a prototype to dilute over-reliance on U.S. logistics and arbitration systems. What began as a workaround to avoid tariffs has now evolved into a global framework. And the countries stepping into America's blind spot? They're not waiting for permission. When Trump ordered 50% tariffs and dismissed the possibility of an EU deal, European leaders didn't negotiate. They pivoted. The European Commission is preparing to retaliate against $95 billion in U.S. goods, while Bloomberg Economics forecasts estimate EU trade could contract by $2 trillion over the next decade if current barriers persist. This isn't economic turbulence. It's realignment. Airbus shares rose 3.7% in Frankfurt following the Boeing freeze. Canadian steel exports to Europe jumped 24% in Q1 2025. CETA's success has emboldened Brussels to fast-track 7 new trade compacts, excluding the U.S. entirely. Former EU Commissioner Cecilia Malmström summed it up in a recent panel at the Bugle Institute. Decoupling isn't a threat. It's a plan. The U.S. assumed tariffs would pressure Brussels into compromise. But with Europe building new trade corridors, empowering alternate suppliers, and reducing transatlantic friction, the silence from Washington isn't leverage anymore. It's obsolescence. So now ask yourself, what happens if Boeing loses Europe? COMAC wins credibility, and the U.S. finds itself shut out of trade deals that span hydrogen, chips, and next-gen aviation? This isn't some geopolitical temper tantrum. It's a surgical pullout. Europe is unplugging from the U.S. One contract, one tariff, one partnership at a time. And while Washington hammers the same levers it's used for 30 years, Brussels is writing a different script, one that doesn't need American approval. So if this $2 trillion break was the wake-up call, then the next chapter, that's where the global order really changes.